We're right on the precipice of falling into a recession. It may well be that the first quarter of this year, which we're still in, that the economy is starting to edge into it. Could be a slowdown, but it's very possible to meet this year that 2 consecutive quarters or perhaps more that the economy actually shrinks in terms of economic activity, and that's what we mean by a recession conventionally. Yeah, we actually were in a very similar situation to this in year 2000. We had just followed a sharp collapse in terms of the stock market. This year, or this past year, we've had a big decline in the housing industry, wealth in terms of housing prices and housing values. And on top of that, at the beginning of this year, a sharp fall in the stock market activity. And often factors like corrections in the stock market tend to precede about 6 months, sharp slowdowns in economic activity and the recession. So we've been in a similar situation to this before in roughly about 8 years ago. It is very much related to the high price of oil in the sense that the high price of oil, to a large extent, is driven by the rapidly expanding economies of China and India. That has put huge pressure in the last 3 years on the price of oil and the price of many commodities, partly because of that strong economic activity and because of the inflation that's caused by those high oil prices. The Federal Reserve pursued, starting back in 2006, so about a year and a half ago, they started pursuing higher interest rates to slow down economic activity, because that's the only tool that our central bank has to arrest inflation, is to actually slow demand, and it's come about. The big surprise that people did not anticipate, both in the central bank and in the markets, was the fact that over these last couple of years, there was a surge in the amount of lending in the form of the subprime lending. Basically, financial markets were taking on a lot more risk than perhaps in previous periods. And now that's come to fruition, it's come to the surface, and that is causing a bit of a multiplier effect. The interest rates cuts will be important, but it takes quite a while, at least 6 months, for interest rate cuts to actually have an impact on stimulating demand by households for new car purchases, new sales of new houses. So that's the purpose of those interest rate cuts, but it does take a while for those to grab hold. The fiscal stimulus in the form of tax cuts is good because it's going to provide money right away. It's going to get cash back in the hands of consumers for which they can spend right away. If we just did the tax cuts, that could have the effect, because basically the federal government's going to be borrowing money in order to finance these. They have no excess surplus of funds, so they have to borrow money. That actually could tend to raise interest rates. So it's great that the Federal Reserve is cutting interest rates, because it'll prevent any kind of crowding out effect to go on from the fiscal stimulus. So basically, it's hard to say which will have more of an impact. They operate at different time modes, but it's great that they're working together, because this is the best kind of policy now to provide insurance that we don't lapse into a severe and prolonged recession, which is always possible. We're borrowing now to try to get ourselves out of that. That's short-term stimulus. That's a one-shot kind of deal. So the question becomes, is the potential cost of that, the borrowing costs and maybe the exchange rate costs, worth the insurance of avoiding a prolonged and severe recession? And I think right now, looking at those figures that are being bandied about, is that's probably an insurance policy worth buying right now, even though in the long run we need to address that overspending that we're doing. The United States economy is still about 25% of the world's gross domestic product. If we just slowed down, the world economy would lose maybe 1% growth, but still be strong. If we go into a recession, that'll likely slow world economic activity enough that it'll be noticeable. In the coming year, I don't think there's going to be an acceleration of inflation. There's basically very sluggish demand going on in the economy, and that's what most are forecasting this year. Inflation basically comes from too strong demand against the supply of goods and services. So with the slowing down of demand going on in the economy, I think there's going to be an easing of inflation over this next year.